Peter Eliades with you. Stock market cycles update for the week ending Friday, January 10th. There's so much to cover, and I don't promise you a short update, but I promise you a really good update with very important subject matter. There's so much going on, so much pointing to at least some kind of top here. I gave you the reasons yesterday why it might not be an important top, but boy, is it screaming that it's going to be some kind of top. The page you're looking at now is my website. And the reason I bring it up, well, there are a couple of reasons I bring it up. First of all, I would encourage those of you who haven't done it. We do a monthly stock market report, and it not only gives the latest projections, but it gives a few things that we have not discussed on these updates, in fairness to people that are paying for the monthly report. I would encourage you to buy the monthly report from last November, and there will be another one coming out probably within the next week. But this November 10th report is an important one because it talks about a pattern that talks about a long-term resolution potentially for this bull market. So I would encourage you, come on, guys. You've been getting a free update now for several months. Bite the bullet and pay $19.95 for this update. I think you'll find it very worthwhile if you're technically or cyclically oriented. That's reason number one I started out my website. Reason number two, scroll all the way down, and where it says Charles Dow Award here, the sign of the bear, the research behind the sign of the bear, won the Charles Dow Award, which is sponsored by Barron's and the Wall Street Journal and the Market Technicians Association every year. This one all the way back historically, actually it was 2001, so it wasn't 150 years ago. But it won the Charles Dow Award that year. And the reason I encourage you to go here and click on the link is that it gives you all my original research on the sign of the bear and shows you charts where the signals took place. I think you will be mystified and amazed at where those took place. Now, I should note that back in 2017, I made a minor change in the parameters for the sign of the bear. There are three conditions. The second and third remain exactly the same. The first condition was changed so that instead of requiring 21 consecutive days of this churning pattern, what I call a churning pattern, only 18 days were required. That minor change made very little change in the overall results of the program, of the research. So, again, I encourage you, you can view this Charles Dow Award link without paying any money at all. It would be nice if you bought the report a little higher up, but by all means, go and click on the Charles Dow Award. What's the website? Well, you see it right up here, stockmarketcycles.com. That's how you get to it. Okay, all together now. Today was day number 17 of the churning pattern. How many more days to satisfy condition one? Altogether, one more day, Monday of next week. If we have an advanced decline ratio above 0.65 but below 1.95 on Monday, we will have condition number one satisfied for sign of the bear. Believe me, those are rare. Those occasions are rare. We went all the way from 2000 all the way up into 2017 before we saw that number of consecutive days. That's 17 years. Back in 1929, a signal was given. There was not another signal given for the next 32 years. This is rare stuff we're talking about, folks. This is not everyday occurrences. Does it work every time? Well, you be the judge of that. Go and take a look at the charts. Why does it work? It's somewhat mystifying. I have some guesses as to why, but I'm not going to go into them here. Okay. Now, a lot of people have said, well, so if that's condition number one, what are the other conditions? Is that a secret? No, I don't have any secrets in my work. I think people that have secrets in their market work, I won't say all of them are charlatans, but I don't believe in having secrets in your market work. You share this with other people that are interested, that are technicians, and they can help you along with you helping them. So here are the next two conditions. First condition is 18 to 28 consecutive days. That's the only condition, condition that was changed. It used to be 21 to 28, but I found that 18 to 28 gives virtually the same results. Couple of more signals given, but they were good ones. So that's condition number one, 18 to 28 consecutive days. New York Stock Exchange advanced decline single day ratio below 195, above 0.65. Once you enter the window of those consecutive days, and we can do that on Monday, the second condition, number two, is that the streak must be broken to the downside. In other words, you have to have an advanced decline ratio for the day below 0.65. What happens, you say, if it's broken to the upside with a ratio above 195? That's the end of the game, folks. That's it. You start the count from zero again. So that's why the next few days are so very important. So condition number two is that the streak is broken. It's got to be a streak of 18 to 28 days. I'll go into it some other time why it's 18 to 28, why it's limited that way. It must be broken to the downside, condition number two. Condition number three, we want to make sure that's not just a one-day break and then we start moving up again and showing strength in the market. So condition number three is you take a moving average of the advanced decline ratio for the 3 days and the 2 days, beginning with the breaking of the streak. So in other words, if the streak is broken one day with a reading of 0.58, that's day number one. You look at the next 2 days after that, and you take a 2-day moving average and a 3-day moving average. If the lesser of those two moving averages is below 0.75, sign of the bear. That's what we're waiting for. And believe me, it's exciting. Go to this link, Charles Dow Award, and look and see the prior instances where this occurred. Okay. Let's get back to the market now. We have some charts to show you. And these are wowie charts. They really are. And one of them you've seen and we showed you yesterday. And we're going to show it to you again right now. And that's this one right here. There's something mystical about this. This is the projection software. Remember, the projection software back in December of 18 gave this projection window right here. Big decline, scary decline. We came down to the lower end of that window, and that's where the market stopped, turned around, and saw a great rally to the upside. When that rally entered into the time period that took place between, let's say, the first crossing was right around, it was in the March-April time period. So we broke above and gave this projection right here by breaking above. And it looked kind of shaky after a while. This is what happened back in July and August. But we didn't really have a day below, certainly not more than a day, below both the lines in terms of the median for the day, the average of the high and the low. So I'm not going to go through the whole story of what happened since then. But yesterday we showed you a close-up of this. We're going to show it to you again. And yesterday when we showed you this close-up, we said, all right, so we missed it by, I guess it was maybe 18 Dow points or something like that. Well, guess what? Just guess what? Look what happened today. The high for the Dow today was 29,009.07. The low end of the projection range, how many of you remember it? 29,006.07. Today, the high of the day entered into the lower projection box for the Dow. After how long? The projection was given here, 1, 2, 3, 4, 5, 6, 7, 8, 9, almost 10 months, maybe more than 10 months later. It entered the projection box. So big deal, you say. Does that guarantee us a market top? No, it doesn't guarantee you a market top. I mean, the upper side of the projection box is all the way up to 30,212 or 13. But the fact that you entered that projection box could be a very, very important factor. So we're showing you that. Let's show you something else. There's one more chart to show you. This chart is, I think, rather spectacular. And I worked on this today. We can get rid of these two lines. I hate lines that you drew in a long time ago that don't have significance anymore. What we're looking at now has significance. Let's begin with the red lines that you see on the chart. And again, I'm going to zoom in on those. This is a simple channel. This is a weekly chart now of the Dow. And the anchors for the bottom side of the channel occur on the low of June 7th and the low of October 4th. So you draw a line exactly between those lows. You almost come down to it on the low of August 16th, but if I zoomed in on that, you'd see you missed it by a little bit. Then you draw an exact parallel for the high preceding this first low, which again was the low of June 7th, the week ending June 7th, and that was the week of April 26th, the week ending April 26th. So that's the anchor for the upper side of the parallel line. Guess what? Should I show you what? Let's do another zoom. Here's the zoom. Do you think we hit that red line today? I mean, wait a minute. Let's have some fun. Because with the great technology we have now in terms of zooming, let's really zoom. Let's really, really zoom. Do you think we hit that line today? Virtually exactly hit that line on the upper channel of the Dow, okay? So that's one thing we did today. Now, what else did we do that might be important? Well, watch this. This is a chart that we took back to, here's the high in 2007. I'm going to zoom in on this so you get a better perspective of all of it. This is the high in July of 07. Now, the reason I used the July, even though the October high was a little bit higher, I'll show you why. Because it's what we call, well, as technicians, an external high. See, if we use the October high, the July high was higher, as you can see from this line. The October high didn't quite get up to it. So we use the external high, July of 07. And then we go through a really important top in January of well, it was January, that said February. But if we zoom in again, I like to zoom in because I want to give you an idea of the perspective of how exacting these things are. This is exactly on the week ending January 26th. That's where the two anchors for this tops line is. This is not a channel. It's simply drawing through two previous tops, okay? Guess where that line is this week? Well, you saw it. It's the black line right here this week. And we can go in a little bit closer. I don't want to zoom in exactly on that because, honestly, we broke tiny bit above that. But the argument can be you broke a tiny bit above that black line so you could get up to the red line. So what are we looking at? Okay, here's what we're looking at. A short-term channel, hit the upper part of it today. The long-term tops line going back all the way to 07, hit the top of it today. Now, there's one more thing that I didn't mention. This is going to be a long update, but it's really an important one. Remember what I showed you yesterday about the two patterns and 109 trading days from the August of 17 high to the January of 18 high? And again, another 109 trading days from the August of 19 low to the January of 20 high. Remember I showed you that? Well, read the remarks below because sometimes you'll learn something. I always learn something from the remarks because we have very bright analysts watching this work. And a fellow by the name of John said, it's not 109 days, Peter. It's 158. Well, the moment I saw that, I knew he was talking about calendar days, not trading days, Because when you do cycles, you can use either one of them. The Hearst work that I do on daily charts now, I resolved it down to using market days simply because that's easier for a lot of people. And for me, it tended to be equally as accurate as calendar days. The way Hearst began his analysis was using calendar days where you'd leave a space for Saturdays, Sundays, and holidays. And I found that there's equal accuracy in leaving those days out. At least that's my argument. So John said, hey, it's not 109 days, Peter, it's 158. Well, guess what? He was right in terms of calendar days, and I told him that. And guess what again? The August of 17 to the January of 18 was exactly 158 calendar days. Yesterday was 109 trading days, but if you use calendar days, it wasn't until today. And guess what we did today? We made a slightly higher high, resolving the pattern virtually exactly from August to January in 158 calendar days and hitting exactly the top of these channels. You can't ask for anything more. Now, let me caution you. All this stuff is beautiful. I mean, it's like a fantastic picture that resolves itself, and you say, well, there's only one way the market can go from here. Never make that mistake. There are several ways the market can go from here. You've seen channels broken above in the past, channels that I showed you that said they could be resistance. They were broken right above. This one might be broken right above. So don't get cocky in terms of any of this analysis. But what I am saying is that this picture is fitting together so well, and we're waiting so anxiously next week to see if we get a sign of the bear. So that's it. This has been a really long update. I hope you have found it as fascinating as I have analyzing it for you. If you haven't subscribed yet, please do so. Bottom right of the screen, click on the red banner. Once that comes up, click on the bell. That'll tell you about all the updates. Whenever we do them, you will be notified immediately. Thank you very much for watching this long update. I hope you enjoyed it. We'll talk to you Monday, maybe with condition 1 of sign of the bear. Have a great weekend.